Hello, it is February 22nd, Monday, stocks of the week. But we're going to do a quick little look at the Macro Monday article before we move on. I wrote something that is at all of the services and also at Seeking Alpha, and a version of this will get syndicated here shortly. About the petrodollar and OPEC's reassertion over oil markets. This is important because it's going to impact the growth of alternative energy in America, but also is going to help the government finance the debt that it's going to run for the next few years. Now, we've talked about the debt that the U.S. has added that is far in excess of the growth that it's generated since the financial crisis. And this report over at Hoisington Management talks about how last year, the Federal Reserve really was eating up the debt issuance. Well, now net debt issuance is going to be up big, even further than this, because this doesn't include an infrastructure package, and that money has to come from somewhere. Well, that somewhere is probably going to be through Saudi Arabia. They have, on a couple of occasions, run their U.S. Treasury debt way up, and it recently fell. Why? Because the falling oil revenues put a lot of pressure on their budget. So their U.S. Treasuries were up to $180 billion by the start of 2020 and had fallen all the way to about $136 billion by the end of the year. But they were trying to wrap it back up as oil prices went up. So we probably can expect a very big dollar amount out of Saudi Arabia. And I think it's going to take them well into the 200 billions. So I'm thinking 100 billion to 150 billion of debt Saudi Arabia is going to buy. And then you have all these other countries that'll buy U.S. debt as well. And why is that? Well, a couple of reasons. One, dollars have become a little bit scarce around the globe as everybody had to take care of their budgets. The United States really is financing much of the world. It sounds backwards because everybody thinks that the rest of the world is financing us, but as the reserve currency, we're the ones who have to float the liquidity to the rest of the world. It's what happened after the financial crisis. We didn't just finance our banks. We financed our banks and Federal Reserve, which then turned around and financed banks all over the world. So what we are seeing is a bit of a cash call. The call has already been made, right? Janet Yellen already called her counterpart in Saudi Arabia, and Secretary of State Blinken already talked to Saudi's foreign minister about how things were going to go. So if you watch this closely, you can see that the United States is saying, look, we would like you to buy U.S. treasuries, and then what we will give you is obviously everything that you get from the United States. And by the way, we're going to do what we can to hold our fracking industry back. But if you don't play ball, we'll let our frackers off the leash and they'll pump as much oil as they want to because we'll keep you out of the market. So there's going to be some sort of a deal, whether it's announced, whether it's quid pro quo, behind closed doors, who knows? But the bottom line is you're going to see the Saudis buy $100 billion or more in U.S. debt, which is, only 5 or 6% of what we need bought. But it's a chip there that is getting played, and it's going to have an impact on oil. And the EIA is already forecasting that we're going to import more oil, it's this chart, over the next couple of years. Why is that? It's because so much of the fracking industry has gone bankrupt, and probably about half of what is left is going to either go bankrupt or mergers will be mergers of less. Meaning, as I talked about the other day, a $1 billion company may merge with a $2 billion company, and at the end of the day, you have a $2 billion company. That's what's going on. There's so much shrinkage in the fracking space that the balancing will probably occur this year and finish up into the winter. And then by 2022, which is when I expected oil to get to $60 a barrel, you'll probably have that much firmer oil price as the control of the market flows more and more back to OPEC. Why? Because they have the most free capacity. They're going to start pumping again a little bit more in April. Saudi Arabia already talked about that. We'll see what the OPEC meeting next month brings, but it's going to have an impact. So what will be the residual, once removed impact of our oil industry not really ever getting back to the peak that they had a couple of years ago, it's going to be that alternative energy is really going to keep taking off. As the EVs come to market, and as I've been telling you for a year, the big demarcation year is going to be 2026. Well, who just told you that? Ford just told you that. So all the announcements that have been happening, I told you ultimately it was going to be 2026 when all the EVs started taking over the market. Ford basically just told us that. And interestingly, that's exactly what I said. Not only did I say 2026, but I also said it would be Ford that made the announcement, and they did. So if you haven't bought Ford yet, that's not really on our Stocks of the Week checklist this week. Ford is a company that should be in your portfolio. That's a stock that should easily go to 20 here in the next year or two, which is a double, or roughly a double. I think it's about 11 right now. We were buying it in 5s and 6s and 7s and 8s and 9s. But it has the potential to really break out past 20 and become one of these meme stocks where people start to go, well, is Tesla ever really going to have the profitability needed to be worth the next 6 auto companies in the world? And the answer is no. There's just no way that can happen. So the other companies are going to start taking some of that market cap back because it's just a function of market share and profitability. And as I've shown you, the fourth industrial revolution technology of Ford is going to make them very profitable. It's going to help them utilize their real estate well. It's going to help them get into joint ventures. Ford is going to end up being a big winner here. And I think probably goes to somewhere between $60 and $100 a share 5, 6, 7 years out. That's how big of a winner I think they can be. And in a world where things happen a lot faster today than they did in the past, who knows? Maybe they have one of these years where they go up 300%. I don't know what to tell you. If the millennials start buying Ford stock with even more zeal than they have been, and it's been a popular stock for them, I think that you could see Ford, become the next Tesla, which is weird because Tesla was the next Ford. So read this article and kind of wrap your head around what's going to happen in the oil space. I know none of you are really in oil, at least I hope not. But XLE will probably get beat up, and I think they might even change what it's invested in. And I think XOP is not going to exist in a year or two. I really don't. I think that XLE will be expanded to include some alternative energy, the E&P companies that they don't already include. And I think that XOP is going to be DOA. Tree Rings, once again, talked a lot about the dollar, about the debt, and what could be coming. Now, Bitcoin, again, finds its way in here. And I think that what a lot of people still miss about Bitcoin is they still rely on the kindness of strangers and government to be what they've been. So I traded Bitcoin just for fun over on Robinhood. I bought it at 40,000. I just sold it today at 53,000. I don't want to encourage people to do that, but I do think that the chart that I'm going to throw in there, which I already have in the alternative section here, is something that you can take a look at. I think that the upside for Bitcoin is clearly 70,000. And given that the market loves big, shiny, round numbers, could get to 100,000. However, there's a time clock ticking now. Janet Yellen talked about Bitcoin and a digital dollar today with the New York Times. I've told you that that's already come up in recent months. The crypto dollar is coming. And in fact, I even mentioned it just in passing somewhere in this article. Yeah, crypto dollar. There you go. At some point, the crypto dollar will come. And when it does, you'll need dollars to buy it. Hence, the world is going to start stocking up on U.S. treasuries. Why? Because that will give them dollars down the road to buy the crypto dollar. Why will the crypto dollar be attractive? Because it's not going to be directly attached to the Fed's policy. I'm telling you right now, the Fed is not going to control the crypto dollar. There's going to be a formula. That's what's going to happen. And I think the formula is going to be tied to inflation. And the reason why is that once you create the initial 80 trillion, which seems to be a number that gets thrown around, once you create the initial inventory of crypto dollars, and then you only increase it by the rate of inflation, you start a process by which the crypto dollar takes the place of all the debt and all the other dollars that are out there in the economy. And it'll take a long time to absorb all those crypto dollars, but it would happen basically over the course of 10 to 30 years. I don't know how fast, but as debt converts to cash that buys crypto dollars that aren't as inflationary as the local counter-cyclical policy-driven Fed dollars, now you have created basically a shadow dollar, a local and a international, and they are symbiotic. So they just have to create that system, which if I can muse about it in my head, as limited as I am for intellectual capacity, I have to think that Janet Yellen probably can figure something out with a couple other smart people in the room. All right, so let's move on to SPACs. SPAC. Where's my SPAC article? There it is. Stocks of the week. The most popular SPACs. Quick thoughts on Starlink since it came up in the chat room this week. You know, I know that not everybody uses the chat room, but it's a great place to stop in. And Teresa on the weekends does a best of chat PDF that she sticks in there. Just look for Teresa's article on fundamental trends. She's Teresa, and over on Seeking Alpha, she's like Vita something or other. I'm sorry, Teresa. I always forget what you are on Seeking Alpha, but it's Visa. Can you type it up there and I'll try to say it? She doesn't want me to say it. Okay. So in any case, oh, Vita amazing. Well, good grief. Well, that was easy. All you had to do is make it phonetic. There you go, Vita amazing. All right, there you go. That was so much easier. See, I can even see Palipatia when I see it. All right, so these are the SPACs that have been issued so far. It's huge. 160 already this year, 248 for all of last year. So, you know, this year you're going to end up with over 300 SPACs. And the question becomes is, what do you do with all of them? You have to be incredibly selective when you pick these out. And we've outlined two ways to approach these vehicles. The first one is buy them close to the IPO, and you want good management, a big pile of money, and some focus and expertise in a secular trend sector or industry. If it doesn't have all three of those things, move on. You can do better. So 331 SPACs are searching for a transaction right now. What does that tell you? That should tell you that a lot of SPACs aren't going to cut a deal. And a lot of SPACs are going to cut bad deals. But the best SPACs are going to cut good deals. And in 3, 4, 5, 6 years, as the zombies in the S&P 500 die, some of these companies will replace them. So last year, I talked over and over about wanting to buy mid-cap stocks. Well, here's your opportunity to buy a lot of mid-cap stocks. So you buy them close to the IPO. You hope they make a good deal. And if they do, you're probably going to double or triple your money fairly quickly, a few years, especially as some of these companies get to be the size, roughly 10 billion-ish, where they get considered for S&P 500 inclusion. And as we've covered over and over again, there are at least 100 and probably 150 and maybe 200 S&P 500 stocks that are zombie status. Their revenues aren't growing. They can barely cover their debt payments. They're going to have to continue to cut dividends. And, you know, there's this huge bailout of the stock market and the dividend payers and the debt carriers by the federal government and the Federal Reserve here last year. But those debts still come due eventually. Eventually, companies that aren't that good, the market treats them as being companies that aren't that good. When does that happen? I don't know. Maybe when the 10-year treasury gets over 2%. That could be pretty soon. Why? Because we have a lot of debt to issue. Who wants to accept a negative interest rate, right? The real interest rate, if inflation is roughly 2%, 1 to 2%, you want to have at least a real return on your money. That means that the 20-year treasury is probably going to get to around 2% pretty soon. And that is going to tighten up liquidity as a lot of money goes to buy U.S. treasuries to finance fiscal policy versus monetary policy. Monetary policy, as we know, goes to the Federal Reserve, into the banking system, gets loaned out to hedge funds and big investors and everybody out there. If it goes through the fiscal side, it's going to companies that build stuff, or to cities and states they can't pay their cops and firefighters and everybody else. That's a different way of getting into the economy. It's slower, it's more real, and although as employment goes back up, you'll see more people putting money into stock market again via retirement plans. I still believe that we get at least some correction here and then rotating corrections. And it's very possible that in the next year or two, we could look back 12 or 24 months ago, wow, we're in about the same place on the averages. But if you take a look at what we've bought recently, especially this year, and what it's done lately against the market, you go, I don't have as much invested in the market as the market does, which is 100%. I might only have 50, 60, 70% of my money invested, but I'm still doing as well as the market this year. That's a great risk-adjusted return. These SPACs are a big part of that. And then obviously a few of our stocks have done real well. So here are the top 15 SPACs, and these are based on financial filings from the hedge funds that are no newer than February 16th, but really are pointing at SPACs that they bought in the fourth quarter. So Pershing Square, right, is up about 50% and hasn't bought anything yet, right? It went to market with $4 billion, and now the market cap is $6 billion, but they haven't made a transaction yet. So what does that tell you just right there? Is that buying the IPO of a good manager with a big pile of money and some focus on a secular growth trend is profitable, because a lot of times it's buy the rumor, sell the news. I think that's what's about to happen at Churchill Capital. I guess the Lucid transaction was verified today. We'll see how much this can run up, but I'll again tell you that Lucid's not going to be able to cover Tesla, and they're not going to be able to break into the luxury market in a way that will generate them the billions of dollars they need to justify the market cap already. The stock is up 600%. That doesn't make any sense at all. How did a $10 bill buy a $60 bill? It didn't. That's the answer. Maybe the $10 bill bought a $20 bill, but the $10 bill, right, that's what these come public at, $10 a share, did not just buy a $60 bill. So when it gets repriced by the market, and it will, unless the millennials decide that they all want a Lucid instead of a Tesla, in which case it comes out of Tesla, we'll see. But I expect that this one, if you had bought this one on the IPO and we talked about it, I think a couple people bought it. I didn't really recommend it. I just, said, hey, here's something to think about. That's something that, can happen. This one has already made a deal with a fintech company. I just started reading up on it. Cone Robbins is one that I recommend. It's the fourth most owned by hedge funds, and it's still cheap. If you don't own this one yet, you should own it. Why? Connected guy. It's going to be something in fintech. It's going to be a big deal. Might even be blockchain. And while Bitcoin might not be long for the world, not as the rock star that it is, blockchain is going to be around, because there is a blockchain solution that can save the banking industry. And what do the bankers want more than anything? To stay in business and collect their bonuses. If Gary Cohn can help them do that, he will. I don't know much about any of these other ones. I started looking them up, and there's some interesting ideas in here. One of them, this one, I think, which I can't even get it to send me the quote, but Juniper Industrial looks pretty interesting. They just bought Janus International, and I think that this is going to be one of the major winners in the new industrial age. So this is going to be one of those boring companies that might just make a ton of money, right? It might be flying under the radar. So go ahead and take a look at this and think through what I've been telling you. There's two ways to make money in SPACs. One, after a deal is made, see if there's value there. That's just traditional investing. But the other way is buy the IPO, find somebody who's a great manager or a great management team, has a big hunk of money so they can buy something past the speculative stage and is focusing on a positive secular trend, right? You don't want to get into a SPAC that's buying oil. It just doesn't make any sense. Oh, have you heard about the new exciting thing called oil? Right? It just doesn't make sense. All right, so somebody brought up Starlink and compared it to Sirius Satellite. And here's the thing with Sirius Satellite. Not really a Sirius Satellite anymore. It's Sirius XM, right? They're app-based now. Yeah, you still have satellite coverage in your car when you're out in the country tooling around, but you can also get it on an app, right on your phone, or in your house. And it's only been US based until very recently. Not really the same type of company as Starlink is. Starlink is low Earth orbit satellites that want to beam down 4G and potentially 5G speed internet connections to people who live away from 5G and cable and fiber, which is basically anybody, in flyover country that's not in a city, which is, half the country. And then everywhere else around the world that doesn't have those quick uplinks. So their international business probably could be pretty good, but they're about to get competition, not just from existing companies, but from companies that have different deals going on. Virgin just filed a lawsuit against Starlink. Why? Because they had set up their network, their satellite array, a constellation, I think that's what they call it, a constellation, in a certain way, based on what Starlink had said they were going to do. Then Starlink changed what they're going to do to block Virgin, whatever they're called now. And so what you see is that there's already competition in low Earth orbit satellite. And Starlink wants to get first mover advantage. And Elon Musk is talking about how they're going to increase their speeds and lower their latency by next year. It's not going to happen. It's going to probably take longer, which is par for the course for Musk, but that's fine. They're going to be a player, but they're not going to be the only player. And here's where the big money is in low Earth orbit satellites. It's providing coverage for cell phones, right? So if you're in the city, 5G is going to work. If you're in the countryside, it might not. So you need to be fairly close to a tower. And satellites aren't the greatest for a city environment. Why? Because there's a lot of places you can't put a satellite up, but also there's a lot of blockage. So these low Earth orbit satellites aren't really designed for the big city. They're designed for when you get out of the big city. And what do you miss the most when you're out of the city? You lose your cell coverage, right? Or it gets spotty. But what if you're driving? I've driven all over the country. I lost signal all the time. The mountains in Pennsylvania, going down south through Missouri, in Vegas, in New Mexico, in Phoenix, not Phoenix, but the trip out of Phoenix to where I was going, whether it be Vegas or California or New Mexico. Texas, I've lost signal. So the big money can be made by partnering with the big incumbent cell phone companies and providing this service to them so that when their customers leave the city and they're not by 5G, they can still get almost that type of speed through their cell phone using the satellite, basically turning a regular cell phone into a satellite phone when it's needed. Guess what? There's a company that's going to do that, and they're already public. So remember when we talked about the company that was going to become Nikola, and then it shot up after the deal was announced? This actually went down today, and it's about $17 a share. AST Science is becoming AST Space Mobile. And this is the company that is going to bring satellite coverage to both AT&T and Vodafone. Now, I don't know who gets the Verizon contract and some of the other big contracts, but I got to think that these guys are on that list because they have those core customers and financing to get rolling pretty quick. They're expecting revenue to push $10 billion in the next 6 or 7 years. I think that's light. I think it's real light. So their constellation is going to cover the entire planet eventually, just like Starlink, right? They're starting near the equator, covering the Middle East, North Africa, but quickly moving into places where AT&T is as well. And they're eventually going to be everywhere. And you're going to be able to basically sign up via text, probably on demand, right? So like when I want to call a foreign country on my AT&T service, I just pay, I think it's 10 or 20 bucks that month, and I get unlimited international calling for like dirt cheap pennies. I think this is going to be the same thing. And maybe they'll contract you in for longer periods of time. Maybe it won't be month to month. Maybe it'll be year to year. Who knows? Maybe it'll just be on your cell phone bill. Hey, this is one of those things you're subscribed to right now. How many of you check that very often? Not very often. So this is a stock that I've been looking at for about a week. It was funny that Starlink came up yesterday, so I threw some hints on the message board about what I was looking at and where I look at it. So this is, remember I told you that I use an AI? This is one of the two that I've used. It's pretty neat. Just go, hey, Space Mobile. and you get all the hits. Or you can go Starlink, bam. You go, wow, look at that. Let's read about this. What does Starlink have to say? Oh, look at that. Starlink opens for European business. Pretty cool. And one thing to know about Starlink is that it's not cheap. It's $99 a month, and you got to buy their equipment. So it is a second best solution versus having a wire, because my coaxial service, which is not great, is still 2 or 3 times better than 5G currently. And fiber is faster than anything. So, you have to weigh how you're going to do things. And my expectation is that somebody like me is probably going to bundle their service if they can. So for my AT&T satellite service, when I go out into the country and I drive around, I'll just pay them, $10 through that bill. Now, if I have Spectrum Internet and Verizon Cell, then I'll probably get it through one of them because they partner. So one of the reasons that we've bought some of the SPACs we've bought, like Liberty, is that there's going to be more and more consolidation in communications and in content. Liberty going to do one or the other, or play off of one with the other. You're going to see that here too. I think you might see Charter and Comcast and part of Lumen cut some sort of a deal. And you might see Dish and DirecTV roll off into a SPAC. That's been talked about like this week, last week. And 1/3 the valuation that sold for 5 years ago or 4 years ago, whenever they did that stupid deal. But it's interesting where those customers are going to end up. They're going to end up with streaming services. Well, then what's the delivery service, right? What's the content side? What's the delivery side? AT&T's probably the best solution to have both. Comcast is there too. Charter's trying to get there. It wouldn't be a bad deal, in my opinion, for Charter and Dish and DirecTV to get into bed together. And one thing that I've had running through my mind is I've taken a look at all these different services. Roku, as fast as they got started, they're going to run into competition, because with content, you can flip it off of your cell phone to your TV and the quality's good. I would think that a lot of budget conscious consumers would do that. Me, I'll pay the $100 a month for the extras. But there's a lot of people, especially globally, who aren't going to think that way. They're going to think, okay, how do I get good speeds with good content for as cheap as possible? Because this is what I can afford. So I would think through that whole equation, not just as a top 10%er, but what if you were in the other 90%? And like I said, everybody who listens to this is a top 10%er just by virtue of having money to invest or being on the verge of having money to invest. So I'm looking at NPA. Yeah, NPAUU is the unit. I wasn't able to get a quote for that on Seeking Alpha, but we can look for it right here. NPA. So Seeking Alpha is not up to date on all this stuff. So you have to go to your brokerage account to look it up. As with all of the things that we've done in the SPACs, if you can buy the units, you want to buy the units because usually the warrants are coming with a discount through the unit. If you buy the units separately, they usually get priced correctly. There's no discounts. But you have to do the math on both. And I was talking to one of our subscribers, and I kind of glossed over the whole conversion thing with warrants. There are provisions in the warrants that protect the companies in the event of liquidity issues and to give them certainty if they cut another deal. That's what those are there for. As those start to happen, we'll cross those bridges when we get there. So here's what I think about Simon. I think they're crooks, but they're good crooks, right? They're screwing people, cities, municipalities, investors, banks, by handing back investments that didn't turn out good. But they've been buying retail investments too, which I think in most cases have been a mistake. Bad utilization of capital. I think that Simon got into trouble because they've been slow to respond to a huge trend that's been around for a very long time, and they've made questionable decisions along the way. They don't really have a fortress balance sheet. When you have to give properties back, how strong is your balance sheet really? Did you have some flexibility to do that? Yeah, because you set it up legally in a way that will allow you to give back some of the bad investments. I'm not a big fan of the management. I know that people want to say that they're great management. I just don't believe it. They've been in a bad space. They haven't done it right on the conversion to new space. An economic shock has kicked their ass twice, and now they're asking for new investor money so they can try again. If you think that this is their good crook cycle, then maybe you want to invest in it. I don't. I don't think their track record is there. Take a look at their performance for the last 20 years. Yeah, the stock has gone up and down. But I think the question you really have to ask yourself is, do you want to live with drawdowns like that? I mean, look at that. Are you telling me that this can't draw down again? Do you think their new money can't follow this same pattern? That's 15 years where it didn't really make any money other than the dividend. And they had to give properties back here, they had to give properties back here, and they had to cut the dividend both times. And now they're buying JCPenney? How good is that management? Really? They rode the easy money here. A wall of liquidity hit them. Then they fell off a cliff. During this whole period, they should have been transitioning their business. They just lived on low interest rates. It's not a gamble that I would make. But have at it if you believe in what I just showed you. All right, I think that is all I have for today. The only swing trade opportunity that I think is worthwhile is I think Barrick Gold is about to get some love. That is a heck of a plateau. That is a heck of a consolidation. If you take a look at Barrick, you think about what does that conversation look like from Janet Yellen, its impact on Bitcoin. And the money that's flowed from Bitcoin or from gold to Bitcoin, is that permanent? This is a very profitable company that's kicking out bigger dividends and doing share buybacks. Could gold go down to 1,600 an ounce? Sure. They still make a ton of money on that. I don't think I would buy calls. Oh, it's a 4-hour chart. That's why. There we go. There you go. This is just a great pattern for a breakout. Somewhere in here, it's going to break out. Maybe when all those U.S. Treasuries start to get issued, right? So I really like Barrick Gold here. I like that it's been coiling here. I like that it had kind of a blow off bottom and then it rebounded today. Scale in. If you haven't been scaling in, I mean, this price down here, I mean, if it gets into the teens, then maybe you buy the calls. All right. Have a good night. Stocks of the week is already published. Take a look at that. And I'm going to write a little swinging for the fences with Barrick Gold.